Good morning. It's Wednesday, the 24th of September, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital. Our top stories and themes. Why the stock markets are directionless once again. Silver has risen more than 50% this year and why it could go further. Automakers are reporting big sales numbers on the first day of the new prices and the festival season. And why a look at India's remittance economy is important in the context of the new H-1B rules.
This is the Call Report with Govindraj Ethiraj.
Swinging markets. It was another day of seesaw on the stock markets as fresh cues disappeared in some ways and the markets were weighed down by an overhang of tariffs and H-1B visas. Nevertheless, they did recover towards the end of the trading session and only closed marginally lower. The Sensex, which hit a low of 81,777 during the day, closed finally at 82,102. That was lower by 57 points. And the Nifty 50 closed at 25,169, down 32 points. The broader market, the Nifty Midcap 100 index was down 0.3%. The Small Cap 250 index was down 0.5%. Elsewhere, markets from the United States to Taiwan are hitting record highs, and we'll come to that in a moment. Meanwhile, stockbroking firm Jefferies has said that software, services and outsourcing, India's signature growth engine since the late 1990s, is giving away to a new one. Over the next decade, the firm expects wealth creation to shift decisively towards hard assets, airports, ports, hospitals, homes, hotels, real estate and renewables as India pours capital into building its infrastructure backbone, according to a report in Mint. I guess what they mean is India will continue to pour as it has been in the last few years. A Jefferies analyst said that the only thing India was missing and that every investor has always pointed out is infrastructure, and that now we are at the point or the cusp of infrastructure upgrade. So what services have been for the past 20 years, I think hard assets will be for the next 10 to 15 years for institutional investors, the analyst told Mint. Meanwhile, all three major indices to return now to international markets close at an all-time high in the US, marking three consecutive winning sessions for the S&P 500, according to CNBC. Nvidia shares jumped about 4% thanks to an announcement from the chipmaker that it would invest $100 billion in OpenAI, the company for the build-out of data centers. Meanwhile, the euphoria around artificial intelligence may have led to the biggest bubble yet in private technology investing. AZ-VC founder and managing partner Jack Selby told Bloomberg, sounding warning bells that a correction in valuations was imminent. Consumers, he said, were getting used to AI services at pennies on the dollar of what they actually cost now. He said in an interview with Bloomberg TV in Singapore, and he said that at some point it's going to have to be priced at cost and probably with some margin. While that time isn't here yet, it'll be here soon enough. And he also drew comparisons, as others have been, to the dot-com bust 25 years ago, pointing at the glut of AI companies, big and small, across the planet. And then gold prices hit a fresh record high on Tuesday. Thanks to increased expectations of further US rate cuts, it rose to $3,784 per ounce after hitting a fresh record high of $3,790 an ounce on Tuesday. According to Reuters, physical gold premiums have risen in India, that is, to a 10-month high this week as record prices in the festive season continue to spur investors to buy bullion in anticipation of further gains, says Reuters. The report also said that India and China are driving up gold rates to some extent for different reasons, though. And spot silver has risen to about $44 per ounce, which is near a 14-year high. Elsewhere, Jefferies, who we spoke of in their shift to hard assets from, soft assets, spoke of gold at $6,600 an ounce, which of course sounds fantastic right now, but you never know. It's already up 50% this year and more on silver as well later. The rupee fell to an all-time low thanks to the tariff and H-1B visa overhang, which could, of course, disrupt service exports, and fell to 88 rupees 79 paise per dollar, closing finally at 88 rupees 75 paise, down 0.5% of the day, which is its steepest drop in nearly a month, according to Reuters, which added that the rupee has fallen more than 3.5% this year, making it one of the region's worst performers. A foreign bank's head of Forex and rates trading told Reuters corporate hedging has effectively anchored volatility and cited a recent trade where a major public sector firm hedged dollar exposure with forwards and sold dollar rupee call options. Corporate activity in dollar rupee options, Reuters said, has surged about 70% to $73 billion between January and August compared to the same period last year. This market was less than $20 billion 5 years ago, Reuters data said. And now, oil prices, which we've really not referred to in recent days because it's been mostly steady, is just under $68 a barrel now. But speaking of oil, the Washington Post is reporting that Reliance Industries purchased about $33 billion of oil or worth of oil from Russia since the invasion of Ukraine in February 2022, a previously unreported sum that accounts for about 8% of Moscow's crude sales over that period, according to the newspaper. Now, Reliance has not violated any sanctions. Actually, it's done it with the blessings of the US, at least the previous administration, or nor has it done anything illegal at this point in buying this oil. But the jump is definitely noteworthy. In 2021, before the conflict, Reliance bought about 85 million worth of Russian oil. And the next year, the figure rose to about $5.5 billion and kept rising after that. Now, Russia, according to figures quoted by Washington Post from the Center for Research on Energy and Clean Air, has exported about $410 billion worth of crude oil since the invasion of Ukraine. And while China is Russia's largest consumer or customer, India has been the leading buyer of seaborne Russian crude since 23. So what CREA says is that Reliance is $33 billion against the total figure of $410 billion worth of crude exported by Russia is quite large for one company. And here's a message from a sponsor. Want smarter investing at your fingertips? With InvestingPro, get real-time market data, custom alerts, and global financial insights all in one place. Join 46 million users already making sharper decisions. Download InvestingPro today. More details in the link below. China is dumping aggressively. China's exports are leading to a record $1.2 trillion trade surplus despite all the tariff threats, and exports are now heading to other countries according to a detailed Bloomberg report. Indian purchases hit an all-time high in August. Shipments to Africa are on track for an annual record, and sales to Southeast Asia have exceeded their pandemic-era peak, according to Bloomberg. And that across-the-board surge is causing alarm bells overseas as governments are weighing the damage of these low-cost imports into their countries against what their domestic industries are facing. Mexico has raised tariffs as high as 50% on Chinese products, including cars, auto parts, and steel. Indian authorities have received 50 applications in recent weeks for investigations into goods dumping from countries like China and Vietnam, according to an official who spoke to Bloomberg. Indonesia's trade minister has pledged to monitor a deluge of goods after viral videos of Chinese vendors touting plans to export jeans and shirts for as little as 80 cents to major cities caused an outcry. We did talk about some of the challenges that Indonesia is facing in a conversation with Priyanka Kishore of Asia Decoded last week, who's based out of Singapore. And we touched upon the challenge that Indonesia faces because many factories have shut down because of Chinese imports there. Silver hits new highs. On Monday, silver crossed about 136,000 rupees per kilogram, though prices can vary slightly from city to city. So far this year, silver prices have gone up about 47,000 rupees per kilogram, or about 52% from about 89,000 rupees per kilo on December 31st, 2024. Now, while silver prices have been rising almost in tandem with gold and are up close to 50% this year, the question, of course, is where could it go? So silver demand continues to be driven by industrial uses, which was not there in previous years and continues to drive it today. I spoke with Ajay, Kedia, commodities and metals analyst in Mumbai, and I began by asking him why silver prices were rising like this and where it could go.
Rightly said, gold has already rallied, but silver is now picking up its rally. Already we have seen in YOY around 55% rally has been seen in silver. The major reason is, first of all, whatever the supporting things for gold is supporting for silver also. But over and above, industrial demand is now picking up. Even ETF, we have heard Saudi has added silver in the reserve. Russia is adding reserve, silver reserve. So I think industrial demand, I would say, is a measure which is supporting silver more.
So if you look at between overall types of demand, is industrial demand the key new driver?
Yeah, see, in 1980 also we have seen silver prices has went to the level of $50 in international in 2011 also. At that time, the industrial demand was very negligible. other investment demand, or we can say other demand was been there. But in 2022 to 25, we have seen extreme demand from EV, solar panel. This new demand has emerged in the market, and supply side we have seen in last 3-4 years nothing has been added. Even the capex story has been slightly lackluster only. Because of that, there was a demand supply gap, and result we know 55% gain in last 1 year period.
And is there anything that has dramatically changed in the last 1 year?
See, in last 1 year, major shift was from the central bank. Up till now, we have heard central bank was eyeing on gold, but last year from Russia, this year from Saudi, the statement that they can add, already they have purchased silver also. So I think that was a first of all bigger trade shift, and secondly, as a investor, one ratio we called gold silver ratio was very attractive. In last 50 years, we have never seen this ratio beyond 90 level. Right now, ratio is around 85, 85, 50. That clearly suggests silver is underperformed as compared to gold. So I think one side, industrial demand, second side, silver has underperformed gold, makes a good bet for silver.
So you're saying at this point, it's still quoting below what it could ideally quote in relation to gold?
Yeah, in last 50 years, we have seen a ratio low as 30 and high as, let's say, 1992. And currently the ratio is 85, which shows silver is currently very undervalued as compared to gold, first of all. Secondly, the demand that is totally new. In last 2025, we have never seen demand from EV, solar, this type of industrial demand that has been first choice as a silver, and last would be the ETF, because in 2006 we have seen with the iShare ETF launching, we have seen the rally to the level of 50 level mark, and this time from 2022 Indian market has traded with the ETF buying. Even last month also we have seen a good inflow in ETFs.
Right. And how are you seeing demand now at these prices, including in countries like India, for, let's say, jewelry or other non industrial uses, and whether that will make any difference?
See, if we see the demand from industry is going to be there, because the use case of silver in EV solar panel is going to be there. But in respect with the jewelry demand or investment demand, maybe we can see some pause over here, because when we talk about investment demand, one will definitely look for a return. Already the gain of 55% is in any asset class is going to be very higher side. So maybe a little bit consolidation or some pullback may be possible. That could be a great level to re-enter. But I think investment demand can be slightly paused from here. But industrial demand, or we can say consumption demand, is going to be continue for silver.
Right. And how are you seeing overall outlook for, let's say, the next year? I mean, do you see that the pace of price rise continuing? I mean, you did say that we will see some resistance now, but if you look at it over a period, let's say 1 year or plus.
I'm very much bullish. See, there are three things we have to understand. Up till now, silver was not in a critical metal side, critical, we can say, mineral side. US this year included platinum and silver in a crucial metal list. After that, only we have seen the demand has upsurged for silver, because now for industrial use, silver is being highly used. Secondly, the investment demand. Up till now, we have always used silver as a consumption part, like in jewelry or making for coins and bar. But now, as introduction of ETF, people now understand that silver can be bought as an investment also. So I think these two things is going to be a game changer for silver outlook. As of now, ETF family offices are very well placed for silver. So I think for next couple of years, maybe this time we can bridge $50 mark, what we have seen in 1980, 2011. And as per our calculation, maybe we can see level like 70, 72 if we see downtime from here to 2.5 years.
Ajay, thank you so much for joining me today. Car makers see a sales bump. Maruti Suzuki, India's largest car manufacturer, has recorded retail sales of more than 25,000 units on Monday, expecting it to touch 30,000. It also said it received around 80,000 customer inquiries on Monday in a report in the Economic Times, which looked at how lower prices and festive demand were driving additional sales. All of these numbers appear to be record numbers for a single day. But of course, this is an unusual period, because remember that between August 15th and September 22nd, that's day before, there was a clear slowdown in sales as customers waited for lower rates to be revealed. Maruti Suzuki also said demand for small cars has been especially strong, with bookings growing by nearly 50%. And they told the Economic Times that inquiries were high and they could even run out of stock for certain variants, and dealers are staying open late into the night to deliver cars to customers. Tata Motors said that it saw 10,000 deliveries on Monday on the first day of implementation of GST 2.0, and it received more than 25,000 inquiries on the same day. Hyundai said that it saw 11,000 dealer billings on the first day of Navratri, marking the highest single-day performance in the last 5 years. Even pre-owned cars saw a huge surge, including presumably in terms of sales. Most auto stocks, including Maruti, Hyundai, and M&M and Eicher, Tata Motors, and Hero, were up almost 5% on Tuesday, according to that Economic Times report. Speaking of vehicles, India's Tata Advanced Systems Limited, part of the Tata Group, has opened a new plant in Casablanca on Tuesday to produce armored combat vehicles in a move that dovetails with Morocco's recent efforts to grow a domestic defense industry, according to a Reuters report. The facility will make 8x8 wheeled armored platform WHAP vehicles for the Moroccan army and for export across Africa. The statement has actually come from the Moroccan government. The plant is expected to source about 35% of its components locally, with plans to raise it to 50%, says that Reuters report. Decoding remittance flows. Economists at HSBC have estimated that 5.4 million Indians in the US cumulatively sent back about $33 billion in remittances to India every year, according to a Reuters report. There are about 80,000 new visa applicants each year, and that would include presumably the H-1B visa applicants. And if they were to not get entry, remittance flows could fall by about 500 million, they said in a Tuesday note. The risk is that more restrictions on services exports follow, and the lowering of the 50% tariffs takes longer than markets are factoring, says that report. So what could be the knock-on effects of the H-1B visa fees, including lower earnings in the near term, thanks to potentially lower personnel on ground for particularly Indian IT services companies? I spoke with Garima Kapoor, chief economist for Elara Securities, and I began by asking her how she was looking at remittance flows in the context of the recent H-1B visa imbroglio.
So, the immediate impact of this should be probably felt from next year onwards, because the rule of the hike in fee does not apply for the approvals that have already been given for this year's H1 visa applications. However, what does this do is, on a broad basis, if you anticipate companies to rely less on H1B visa program, roughly India's delivery model for IT services exports is that 50% goes from GCCs, another 35% is contributed by offshore, which is by the company setups in India. Another 50% is contributed by what you hire through H1B visa on site. Now, assuming that over a period of time, this 15% is what will get impacted, because you will also take time for this 15% to gradually be distributed among other options like GCC enlargement or the better services through offshore model. The broad consensus and the number that we're working with is roughly we have about 400,000 H1B visa applicants from India every year. Assuming at 110,000 average or median salary for the entry level role, tech heavy role, then at a 10%, 20% or 30% impact, assuming a disposable income of 10% being sent to India or 20 or 30%, we're looking roughly at 4 billion to about 13 billion impact in terms of inward remittances into India. Now, taken as a percentage of total remittances that India receives, these are pretty large, about 10 to 30% of the total gross remittances that India receives annually.
From the US?
No, annually across the board, not just from the US. So we receive about $135 billion worth of gross remittances. So if the impact of H-1B visa is such that you will hire lesser people on site, then you can have an inward remittance impact of anywhere between 4 billion to about 13 billion, depending on what is the percentage of disposable income that we assume is being sent back home into India. So as a percentage of gross remittances that India receives, this is anywhere between 10% to 30%. And as a percentage of India's GDP, which will matter then to your current account deficit, this is anywhere between 10 basis to 30 basis point.
Right. And you're assuming this is on a zero basis, right? That means if, let's say, no one goes, it could be 13 billion, or what's the band that you're looking at?
Yes. So, assuming that over a period of time you are likely to reduce your reliance, then the worst case impact that you're looking at will range between for 4 billion to about 13 billion is what the estimate is. Assuming this is a stock that is being targeted. In any case, as US as a geography becomes less attractive for, let's say, tech heavy or super skilled individuals to emigrate, then the number of people also that who would like to choose US as an opportunity for education will also get impacted, which in some ways will have a positive impact on your current account because that would increase your outward remittances if you're sending your children abroad. But this takes into account only the impact, 100% impact if, let's say, the reliance on H-1B visa was not taken into consideration. Depending upon how much is the reduction that you eventually see in terms of number of visa applications from India, of course, the eventual impact would be 50% of what number I quoted or 25%. But that will happen over a period of time.
Right. And just to go back to the other figure that you mentioned, you said 15% is your onshore revenue, which means what? Are you saying that these 100,000 engineers generate 15% of India's exports?
That's right. So, out of a total IT service exports, your delivery model is 50% concentrated into GST and at the 35% offshore, which that is what happens out of India. And the remaining 15% probably is on site through which you take H-1B visas are used for.
So if you take a company like TCS or any company which has a reasonable export exposure, what would their figure for onshore, which is US onshore revenue be like?
So, onshore revenue out for large companies like TCS could be even more because remember that's the second largest user of H-1B visa applicants. But what I'm talking about is industry as a whole.
Right. But if they don't have onshore engineers or onshore representation, does that mean that that revenue disappears or it just transfers?
Now, over a period of time, ideally the revenue should transfer. So, assuming that you continue to operate out of US because your client demands so. So, there will be some absorption that will be felt in terms of cost. So, it will reflect in your margins. A part of the cost would also be taken up by the tech companies because their reliance on Indian IT service providers is high. But assuming that over a period of time, because this model has been evolving, ever since the visa costs have been rising, and this has been a pattern for the last few years, the reliance of IT service providers on the onshore model has been reducing. So, safe to assume that the ambit under which the GCCs are being set up in India, the ambit of the services that GCCs in India deliver could increase. So, this 15% could get over a period of time distributed between GCCs and offshore, while some may continue as a strategic reason to continue to operate. But safe to assume that this will see some bit of diversification. So, the eventual impact should not be entire 15% of loss of revenue.
Right. Last question. So if I were to expand this now and ask you about the overall remittance economy, are you seeing any impact of this on the overall remittance economy, or is that going to chug along as before?
Over a period of time, given that US contributes 28% to remittances of India, and given the way US administration is moving towards becoming more and more closed in terms of allowing immigration, even high-skilled immigration, they're clearly putting a price to basically super skilled labor. So naturally, the preference might reduce unless other countries have the absorptive capacity or tech sector in other countries, particularly European or otherwise, some absorptive capacity to be able to absorb the kind of STEM graduates that India produces each year. You could see some bit of disruption in the shorter term. But having said that, another sizable about 17 to 18% of India's remittance inflows come from Middle East and about 10% comes from UK. So long as the economic outlook of these countries does not look very significantly impacted, and so long as we do not see a significant crash in oil prices, for example, we should not see a very negative impact from rest of the sources of India in world remittances. But yes, once the decision in terms of hiking H-1B visa fees does look to be disruptive in nature, which could actually change the course in which we have understood or we have or US as a geography has evolved for absorbing India's tech graduates.
Garima, it's been a pleasure. Thank you so much for joining me.
Thank you.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.